Welcome back, everyone, to the European VC podcast. Today, I have a treasure for you because I am talking to Avid from Ontario Teachers Pension Plan. And before you get all hyped, no, she is not leading the fund investing arm. She is doing the venture growth arm. So we're in this conversation diving a lot into the organization of teachers, which is what they're called between friends, and also a lot about the growth stage dynamics that are happening in Europe, where they're betting big, as well as AI. We talked only a little bit about AI, and that was on me. I didn't want to do too much AI because we do that so much. So we're saving that for another time. And then, of course, we end on talking a bit about advice to founders and VCs operating in today's world. I really hope you enjoyed this conversation as much as I did making it, and I hope to see you around in the ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Avid, welcome to the European VC podcast.
Thank you. I'm excited.
I was just saying before we started that I got a WhatsApp with a picture of you moderating a conversation at Kindred's event, and I was told I should look very much forward to our talk today. So I am.
Next time, the bar is set high.
Absolutely. Avid, let me just start by recapping the core stats on who you are and the Teachers Venture Growth Fund so that we have that stated for the audience. And then maybe you can provide a bit of context what I got wrong and what I got right. So,
Sure.
Avid, you are a senior managing director for EMEA at Teachers Venture Growth. Tell us, you have like zero fund size, and that's because it's not available because you're structured differently. We'll talk a bit about that, obviously, as a pension fund. But you have 5.4 billion euros under management. The headquarters of Teachers Venture Growth is in Toronto. You're focused on Series B, so we're going to talk a lot about growth investing and contrast that with the US. And you're targeting globally, but you focus primarily on Europe, North America, and India. And then, of course, you're investing in tech, and you've done some incredible investments, including Allen, Beamery, Canva, which I'm a big user of, Advantures, we all know, Databricks, DeepL, Instagrid, Lendable, TaxFix, and this little known company called SpaceX. Did I get some of that right? Did I get something completely wrong that you want to say, Andreas? You're stupid?
You got most of it right. I think that one thing I'll explain a little more is what you were saying around what Ontario Teachers is. So Ontario Teachers is a 250 billion pension plan, which most people, when you say that, their eyes kind of open and they're like, how is that even possible that a pension plan would be so big? Yeah. That's it's been around for 30 years, and it's the Canadian model. And it's also been a pioneer in Canada, where 80% of what, and internally we call Ontario Teachers, so 80% of what Teachers does is direct investing, and only 20% roughly is through funds. And so it has built an organization of roughly 500 investors globally. So you're right, across India, across Asia, across North America and Europe, investing directly in multiple asset classes. So infrastructure, private equity, public equity, you've got credit, you've got real estate, and we own a number of these assets or have very large stakes in them. So whether it's airports or agricultural land or gas networks. And so think about it as a very large asset manager, but who's at the service of 340,000 teachers in Ontario, Canada. And our raison d'etre is to make sure that these teachers get paid their pension securely and regularly for the rest of their lives. And that's ultimately what we do. As part of this, a little over 5 years ago, Teachers created a new asset class, which is technology venture growth investing, which is the asset class that I'm a part of. And that's where we invest, we take minority stakes, We do, like any growth fund, we will lead the round, we would price them, we'll sit on the boards, and we will stay until whether it's IPO and sometimes beyond, because we can cross over. So that's the main difference then with a traditional growth investors, because we have these asset classes and we have publics, we can cross over.
And you just said that most people's eyes widen when you say 240 billion, yes.
Yes.
But at the same time, those people's whose eyes widen are typically VCs, and that's because they see a very big potential LP there. Does Ontario Teachers do any LP investments at all?
Yes, we do. So we invest about roughly 20% of what we do, even in the TBG asset class, is in funds. So we are invested in some of the great funds that you know, and proudly so. And then 80% we invest directly, and we'll invest with some of these funds. Sometimes we'll we'll lead some of the rounds that they may have been in previously. Otherwise, we don't need to have them in the companies for us to invest. So we create our own thesis on investments.
Is it out of the same arm, the venture growth arm, or is it out of another?
So for the venture funds, it's out of the same group, which is Teachers Venture Growth. And then we have a leader that leads the funds investing and works with each of the direct investors as well.
So all the capital hungry VCs listening in, should they pitch you, or should they shoot it to a colleague of yours?
I'm very happy to introduce them to a colleague of mine.
Yeah, okay. And Avid's email is so yes, you all know now there's a big player called Ontario Teachers Pension Plan that you can reach out to when you're looking to fundraise. Let's leave it at that and focus on growth stage investing. We actually had just one final note on the pension ecosystem in Canada. We had Mike McGraw from Innovia on the podcast. I recorded it yesterday, so it'll probably go out shortly before this one as well. And he talked about the Maple 8 and how he used to be with one of the other pension funds, and he described the $1.3 trillion ecosystem of pension funds in Canada, which is obviously massive. So very interesting for anyone that's looking into how the pension funds work, and why there's also a big case study on why Canadian pension funds are so successful as they are. But now let's focus on you fully. And I want to ask you a bit about your journey. So how did you end up first here at the Teachers Venture Growth?
So I joined about a little over 3 years ago. And my background has been going back and forth between investing in high growth technology companies and operating. I'm an engineer by training. I studied, I have a bachelor's and a master's in engineering from Stanford. And then I went on to be trained as a product manager at a number of startups, and then eBay for a number of years, and then went to business school, and then had my first experience as a VC at Excel Partners. This was back in 2006, so that ages me. But and it was my first experience in VC was when I came back so I lived in the US for 10 years and moved to London to work at Excel. And after Excel, went and started my own company, which was an online marketplace for independent brands. After which I joined Google Ventures. We sold Quitica, and I was at Google Ventures as one of the GPs starting the European office back then. That was 2014. And I was there for 4 years. Then I went into one of my portfolio companies, which is Cobalt Music Group, where I was the chief operating officer. And then I joined Teachers about 3 years ago. And the reason I joined Teachers is after Cobalt, I kind of paused and thought to myself, what do I want to be? Do I want to be an operator? Do I want to be an investor? I got to make up my mind. And I took a bit of time. And during that time, I was investing with a group of friends and operators as part of the Operators Network. It's a number of us were angel investors or friends of one of the co-founders of Okta, Frederick Perez, who I went to Stanford with, and whose wife is also a really close friend. So And when he IPO'd Okta in 2017, very quickly he was getting a lot of inbounds from people asking him, can you help us? Yeah, here's my company. And so he decided to put together this group of buddies that would look at these investments together and angel invest. It's not a fund, but when we started doing that, and mostly it was, we have our Slack channels and we look at companies together, and there's different people with different areas of expertise. I realized how much I love doing that with the right group of people, with helping entrepreneurs, being at that part of the journey where you're constantly talking to people who think they can walk through walls and change the world, and you get to see so much. There's so much breadth to what you see. So for someone who's intellectually curious, it's incredibly satisfying and fulfilling. And so through that, I thought, okay, I want to see if I can find a place that has both this aspect of culture that I really like, of working together with people, being close to innovation and investing in it, but also building something. I've always liked the journey of building something, whether it's building a product, whether it was building my own company. Part of the frustration I had early on at Excel was I was very young and I wanted to be the entrepreneur on the other side of the table, which is what I did. I went and did that. So that's always been with me. And when I met the people from Teachers, it combined so many of these things. It combined enabling me to build this new practice of Teachers Ventures Growth, which is a new asset class, and build it in Europe. It enabled me to do this investing, which I love, and helping entrepreneurs in an environment at Teachers where, it's incredibly ambitious. It's constantly reinventing itself. It wants to win, but it doesn't compete internally. It really cares about its people, wants to grow its people. And that was really important to me. And it's global. So it enabled me to have a global view. And the cherry on top of the cake was the impact.
Can I ask you, being in VC, but at a pension fund, whereas almost everyone you're dealing with are at funds.
Yes.
What kind of do you look to the other side and may be envious about? And what do you think, I'm so lucky I'm at Teachers?
So you got to remember, I've been on both sides, and there's pros and cons to everything in life. And no matter what you do, whether it's your job, personal relationships, decisions you make. And so you pick and choose what you're willing to compromise on. I think that, the pros from a pension plan perspective, it's long term. We don't, firstly, we don't raise capital. So a lot of, the job of a GP is to constantly raise money for the next fund, which takes away from the fun of kind of being with the entrepreneurs and finding the next company. But it also makes for almost better VCs because you become more empathetic with the fundraising journey if you've never been through that journey. We're also, as a pension plan, you're a long-term player. So we truly don't need to return capital within 8 or 10 plus 2 years, right? We don't have any LPs. It's our capital. And if the company's doing well and accruing value over time, we can stay in it. We can go public. There's nothing that forces us to return capital to raise the next fund. And so that makes it much more flexible, and it makes the pitch to the entrepreneur more aligned, truly aligned. So that's the other part. Now, that I would say, one of the cons, or one of the things sometimes I'm envious when I look at the other side, is that the teams are really small, right? Like, I'm part of a 1,500 people organization, which has a lot of governance around it, rightfully so. And so there's a bunch of internal reporting that I have to do that when I was at BCs, I didn't have to do. But it's a very small price, I think, to pay for a lot of the great things that we get. The other part
I venture to bet that were you in a venture firm, you'd be likely a managing partner, which means you'd be fundraising 20 or 30% of your time. And I don't
Yes.
think that your reporting takes up 20 to 30% of your time. I at least hope so.
No, it doesn't. You're absolutely right. You're absolutely right. The last thing I'd say that I didn't realize before I joined how valuable it is, and it's completely changed my view of the world, is the ability to look across asset classes globally. There's so much interactions between the publics and the privates, between what's happening in real estate and infrastructure and energy today, especially with AI, and what we do in the privates, what we do in the publics, what we do in private equity. And having then the macro umbrella that's, we have our own chief economist that's constantly looking at what's happening in the macro and educating us. We have a total fund management team that balances the portfolio and has a view, 2, 3, 4, 5 years ahead. And that makes, I think, us as investors much smarter.
Yeah, maybe you could dive a bit deeper on how you ensure, or how you leverage that you're a big organization, like you just described, the economist, that you can kind of like level everyone up across the organization. What other things do you think keep you better?
A number of things. I think we have about 100 portfolio companies outside of TPG across infrastructure, real estate, private equity that, as I said, they go from utilities to dental practices to agricultural land to data centers, where all of these can be partners, they can be customers of the TVG portfolio companies. And there are very different sets of portfolio companies versus your typical VC, which will likely have mostly kind of companies that are at the same stage and life cycle as you. And so it creates a very different value proposition. And we spend a tremendous amount of time creating these connections for our companies, other than ourselves being customers of many of our companies. So we're customers of Comply, we're customers of Beamery. As Ontario teachers, we're soon to be customers of DeepL. So because we have this whole pension side, which is an operational side of 500 people that works like an operational organization and requires a lot of these tools and software. So the value of the ecosystem is tremendous. We have a huge presence and influence in Canada, which helps significantly with Canadian entry for our portfolio companies. So we recently announced Alan's entry into Canada. And so for those who don't know, Alan is a combination of an extremely efficient health insurance, an AI-centered technology company, and healthcare services provider. And they serve roughly, call it 680,000 people across Europe. They recently obtained a license to operate in Canada, where there hasn't been a new health insurance company since 1957. And we've been incredibly instrumental in helping them navigate that and then building the teams in Canada and the board, and then creating the outcome of this launch recently that we very happily and proudly announced. And so that's an example. We're working with DeepL to do a similar entry into Canada, given the bilingual aspect of Canada, where DeepL is, for those who don't know, a machine translation company, which has been around for a number of years and serves enterprises and mid-market companies with translations in over 30 languages. So if you're an enterprise who cares about your marketing translation, your legal, if you're in healthcare, you care about quality and accuracy, that's who you use. And so that's, again, a place where Canada, it makes sense for them to enter. So we'll help a lot with entry into Canada, but also international entry into companies and portfolio plugging.
Avid, just to make something super clear to everyone, does Teachers Venture Growth only do the late stages, or do you also have an arm that does early? Just because I want to ask a question that's connected to that.
No, we only do B+, so post product market fit. with roughly 10 to 20 million in revenue looking to scale. That's where we start.
Is that because you are very much also looking to leverage? So first of all, you have a lot of capital to deploy. That's one good reason to focus at the later stages. But also, is it because you're also very much getting into rounds because you're leveraging the whole organization strength, and that is just, works better at the later stages versus at seed stage, because a big corporate does not really work super well with a seed company, and the seed company gets too close to the large one. Is that part of the thinking as well?
I think it's a couple of things. One is, we are 250 billion assets under management. So putting 5 to 10 million to work on like 100 companies is not going to move the needle. It's also different. It's a different skill. And investing in kind of early stage versus late stage requires different skill sets. So that's really one of the major reasons. The other ones is yes, going back to the skill set, there's a natural understanding of a growth stage company within Ontario Teachers culturally that makes sense to build for that and then use our existing network to plug these companies into. So there's a lot more leverage for them at a stage where they're trying to scale versus a stage where they're trying to find product market fit. So that's also another reason why. And then there's a lot of the equation is a risk return equation. So how much risk are you willing to take for what kind of return? I was mentioning we have this total funds management that looks at how we balance the portfolio. And within that equation, having a higher risk, higher return asset class like TVG makes sense. Skewing the risk too high doesn't make sense in that portfolio construction, which is where seed and Series A come in.
Avid, I'd love to ask you, because there's a dynamic, and I really want to dive into this. There's a dynamic in European growth stage that I've been recently made aware of that I found incredibly interesting, that I'd love to ask you a bit about. Kind of, if I describe it from the top, we've very much for a long time in Europe fought against that we have had early stage investors that came with a private equity mindset, which meant that we did not, we were structuring deals incorrectly. We were having what US investors would consider predatory terms. We destroyed the cap tables and so on. This is obviously 15, 20 years ago. So we're way past that in the early stage. But what a couple of guys have said to me is that at the growth stage, we actually have a bit of this dynamic, because yes, we have great growth stage investors like yourself, obviously, but we also have a lot of, crossover investors from private equity that very much comes with a private equity mindset and playbook. And now with the increased focus on profitability and so on, it can be, it's correct to say that we have enough capital in Europe at the growth stage, but that capital may sometimes a bit too often come from people with a non-venture mindset. So in other words, they come with business plans that do not set you up for what we might call a blitzscale growth trajectory, but rather more conservative one. Is that a fair characterization of Europe as you see it? And I know sometimes I lose nuance when describing this, but I'd love to ask if there is some of this happening.
I haven't seen it in a broad brush stroke as you're talking about. If you talk about the last kind of 2 years, I could see why somebody would say that, because you've started to see a bunch of structure happening. But I don't believe that's because it's a different growth investor that's coming, that's more private equity type. I think it's part of the challenge of what happened over the past 2 years, which is valuations were incredibly high, wrongfully so. And everyone was writing that. And when we had the rates kick in and inflation kick in, and people realized that the cost of capital was no longer zero and was actually constantly increasing, and that you couldn't justify growth at all costs anymore, some entrepreneurs and some investors in those companies didn't want to take a valuation hit. and wanted to kind of address that through different mechanisms of, higher lick prefs or a higher downside protection in a fancy way with some structure or convertible or, and you've had companies that have layered convertible on convertible, but that's been done in kind of coalition with the entrepreneur, the existing investors, and a new investor coming in. I think that's wrong. I think that's actually unfortunately, it's a very painful way that oftentimes you then need to go and unwind if you want to give the company a chance. And unwinding these structures means recapping companies, and it's painful. It's painful for everyone around the table. So I think for a particular point in time, that might be true, but I don't think it's necessarily European growth investors versus others. And there's tons of growth investors in Europe that have come from the US that are not necessarily private equity firms, that are kind of VC firms that are doing growth here, whether it's like, us coming from Canada, but having a massive presence in Europe, or whether it's Index that does growth, or Sequoia that does growth, or Andreessen, or Lightspeed, there's tons of them. So I don't know if I agree with that statement. I think it underestimates the amount of capital, the diversity of capital that exists in Europe, the diversity of partners, and it also underestimates the influence existing investors have when they're accepting new investors in, and the say of the entrepreneur.
I'm going to be digging into this more in different episodes to get different perspectives, but thank you so much for debunking it, at least from your perspective. Okay, then let me ask you, a somewhat similar question, but instead of asking it as, do you agree with this thesis? I'd rather ask you, where do you just see European growth do very well? Where do you think that we could be, better, or we could maybe just improve?
So I think there's two aspects of it. I think there's an opportunity set in Europe, which I think is bountiful, whether you look into everything that's happening in AI, even from a growth level, there's more and more that's interesting. Whether you look at the energy and climate sector, where there is tremendous companies, and there's also regulation that helps move faster. Or if you look at a new area that we're spending a bit more time, which actually cuts across AI and cuts across climate, is this Industry 4.0, which really takes advantage of the manufacturing heritage that we have in Europe, which I think is now being unlocked because of the data that's being unlocked within these organizations. And this is something that actually we're talking about Leila from Kindred, Leila Zenia. She's on one of our walks. She's the one who was pointing this out to me and saying, listen, yes, we do SaaS in Europe, but our heritage is manufacturing, and we can now really focus on that, whether it's manufacturing or healthcare as well. So I think there's an opportunity standpoint that is there, that is rich. And we can dig into each of those things if you want. There's also then, how can we do better? I think some of the things that growth is harder in Europe. Why is it harder? Because it's not a single market. It is like if you start your company in the UK, or you start your company in Germany or in France or in Sweden, you will ultimately invariably have to go to another market if you want to build $1 billion company. And getting to that other market is difficult. It's a new culture. It's a new set of regulations. It's new teams. All of that is tremendous amount of friction. Whereas if you start in the US, you have less of that. So you might say, well, state by state things change, are different. Yes, but it's not the same friction as you get in Europe. And so that if you're going to go from the UK, for example, to France, and then from France to Germany, and then from Germany to Spain, that's a lot of friction, and it's incredibly difficult. It's not doable. It's absolutely doable, but I think people need to just take stock of that and realize it's not the same as scaling into the US, which is why you often see a company start in one European country and immediately go to the much larger US market. The other part is talent. So, and that again takes time. So, what do I mean by talent takes time? When I moved to London from the US in 2006, the difference between the talent then in kind of technology and company startup building and what's now was night and day. And why? Because over time, you've got a lot of the big software companies, the Googles, the Amazons, the Apples, the Twitters, having built teams here in the UK, in France, in Germany, and training a bunch of people to become great product managers or great marketeers or great engineers. And those people have gone and joined other startups or have started building their own companies. We've also had over time companies that have startups that have grown, that have had successful exits, that then those entrepreneurs or employees become angels, or they go and start their own company. So it's a whole ecosystem that builds on itself, and that just takes time. It constantly builds on itself. And today, I think we lack still talent at the growth stage who has built companies that are, what we're talking about, 100, 200, 300 million in revenue, global businesses that are that C layer of individuals that can help with that scale of growth. And we often get them coming from the US. That with time will also improve because we will have more of those in Europe and we'll train those and those will come. But I think that talent today relative to the US is still lacking, and which makes it more difficult.
I'd love to ask you a question because every time I find myself in conversations with politicians and policymakers, they oftentimes want to talk about the strength of their ecosystem, and especially in Eastern Europe, how is our ecosystem and its development stage, is that an inhibitor to growth stage investors want to come in? Can we build companies? Can we today build a company like UiPath, which was like a complete outlier and incredible that they managed and so on? But is it plausible to imagine these companies being built everywhere, or are there just requirements to the ecosystems that they're born out of that for you as a growth stage investor, when you look at a company that's Series B or C in whichever geo, where you then say, no, I like the company, but I'm just afraid of the region. I'm afraid of the ecosystem that's around it. Or do you, like what I at least say, and I know that the early stage is best, and I know that at the early stages, no one will stay away from a Bulgarian company because it's in Bulgaria. But I actually don't know if that's true on the growth stage. So if a company has gotten to the Series B, Series C stage, and they're still in Bulgaria primarily, like, would you then say, and I'm just using Bulgaria as an example here, but would you say, no, the ecosystem around this company is not strong enough to make the bet, even though we actually love the founders?
No, absolutely not. I think at the growth stage where we invest, your post-product market fit, you've shown that you can execute on your vision and then you need to scale. What we look for then is the ability for this team, no matter where they're located, to build a global business. And I believe you can build a global business today from anywhere you want to build a global business. Frankly, primarily thanks to technology that allows us to do that. As long as there's rule of law that we trust, right? So, and in Bulgaria and in Europe there is, then it really doesn't matter. Then it's a question of, can this team attract the talent that will help them get to the next level? Do we believe that the market for, does this company fit our thesis? do we believe that this is the best team to do this? Not because they're in a specific location or not, but have they been able to attract, no matter where their location is, the capital, the talent, the customers, the suppliers, the partners? That speaks for itself.
Yeah, I say the exact same thing. So, but I have to also say I don't know the growth stage as well. So I'm super happy to hear that you echo what I also say for the early stage. Now, Avid, you said about manufacturing and health. I want to start first on manufacturing slash industry 4.0. I come from a small place called Odense in Denmark, which had two big robotic companies by Danish standards. They exited for around 250 million each to Teradyne. So this is actually very close to my heart. And I'd love to ask you a bit about how you as a growth stage investor looks at this sector, because this is, notoriously heavy when it comes to machinery and the types of investments that VCs often don't like. So maybe you talk a bit about that, how you think about it, where you're seeing it's scalable and fits into the venture model, and where you say, no, we don't like it. And maybe you can draw a bit on the SpaceX experience, because if anything is not software, that's probably the one.
True. And we've done a combination of software hardware investments as well, like Instagrid, which I think I mentioned to you previously, which is a German company, and they're the first to commercialize battery power packs to replace traditional generators. So if you're on a movie set or a construction site, instead of using your generators, you take this Instagrid battery pack, which is much less carbon emission, much less costly, much less noise, and that's what you use. That's, in effect, a combination of hardware and software, which we invested in at the beginning of this year, and we're super excited to help them internationalize. And they launched in the UK and US and Australia. So we believe in that. Again, a lot of it is, I'm a big believer in thematic investing. I think that if you have a thesis on a theme and you look at the landscape and understand it and understand how customers adopt technology within that space, what the barriers are, what the true need is, not kind of the vitamin, but the medicine, the pill, like what are you trying to unlock, what's not worked before. So we really do a deep dive. Then you can find companies that, no matter whether they have a combination of hardware or software, that you believe will disrupt that area. And so we're at the beginning of this kind of what people call industry 4.0, but it started from this thematic building. So thinking about the manufacturing heritage of Europe and thinking about, manufacturing is the largest single sector in the European economy. It represents 20% of GDP. It employs 30 million people. It generates 8 trillion in turnover. Like, we're talking about consequential TAM here. And the sector comprises of over 1 million enterprises, from micro and SMEs all the way to some of the Europeans' largest businesses. And so what's interesting, though, is similar, I think, echoing a little bit of what you were saying in your question, is the sector is one of the lowest adoption rates of digital technologies. And so you have multi-billion revenue companies that are still working on a patchwork of on-prem manual tools, Excel sheets. And so the promise of Industry 4.0, which I think is accelerated by this push of AI, which has awakened people to the importance of data and to the importance of managing and owning and accessing your data, has tremendous potential in this kind of industry, in this manufacturing sector. And it's applying the analytics, the intelligence and the computational power to this industrial world. So that's how we look at it from kind of a thesis and thematic perspective. We then, some of the things, one of the reasons we believe that there's been low adoption of technology is because a lot of the technological approaches have been to go in and kind of bringing a new technology that replaces existing workflows and processes, and you can't do that in manufacturing companies, and certainly not in manufacturing SMEs. And so what we believe is the retrofit model is where you need to work within the existing ways of these organizations, where CapEx cycles are really long. They don't want to throw away the CapEx that they are. In fact, we're talking about 10, 20 years of CapEx cycles. So how do you then bring technology into that without disrupting what they are doing, but adding data to it? So that's where we look at it. That's how we look at it. And there's a bunch of companies that, we just we're just hoping to win a company here that we really like, that fits exactly this thesis that I told you about. So we're very excited.
Could you tell me a bit about how you, as an investor, that since, as you said, you started in Excel in 2006, that means 100% for sure, is my bet, that you definitely come from a background of doing pure digital to now doing more hardware as well. What has it required for you, as well as OTTP, to really be on this journey of going from being growth stage investors in pure digital, please, to also being able to deal with all these dynamics of dealing with hardware? Because that's a transition point that a lot of funds are going through right now. How can they get on this? Because I think we all agree it's very clear that the next big cycle is going to be, yes, we have AI and pure AI in software, but there's also a huge one in the intersection point between hardware and software. So I'd love to hear how you've dealt with that journey, because it sounds like you're quite far on it. I'd love to understand that.
So the OTPP journey is very easy. OTPP invests in utilities. OTPP invests in real estate and kind of infrastructure. Right. So it's not hardware per se is not scary in any way, shape, or form.
Yeah, and your pure private equity arm has been doing these investments all the time.
Correct. So there's not, from that standpoint, like an organizational cultural shift doesn't need to happen. My personal journey, I'm still on it. I also have the luck and the smarts to work with people and hire people that are much smarter than me on areas I don't know anything about. Yeah. So on our kind of climate thematic, sustainability thematic, and looking at Industry 4.0, Sharon Mahanti, who's on my team, is the one who leads that and who educates me on a regular basis on it. So that's how my personal journey is basically working. Is I think you realize that it goes back to what I was telling you. You realize if you have a macro view of the world and you realize what direction the world is going, and you have the resources to shift in order to take advantage of these trends and participate in kind of building this world, then you're in a great place. And that's what Teachers affords us, is that we can do that, and I can, get the right people around me who can help teachers and also help me better perform in these areas.
I think we're on such an interesting journey in so many firms where you're starting to, see them try and figure out how to deal with hardware and deep tech within a generalist firm that, might have 3 partners or 4 partners or more that are pure software. And then there's this addition to the team that's then deep tech and comes with completely different mindset, completely different understanding. And seeing those firms and hearing, and I've had these conversations, right, with a managing director or the managing partner level, kind of trying to bridge everyone's perspectives and make sure that everyone understands each other. And then hearing at the same time the deep tech partner's perspective of, it's so difficult to bring this into the IC, and all the questions I get, I'm like, why don't you get this? I'd love to talk to your Kieran as well one day and hear his perspective. Do you see some of that as well? Making sure that everyone in the IC understands like both sides and how they fit. And at some point you have to decide, even even with your size of fund, you still have to decide where do you put the money in the end. And though it's just different metrics when you're talking hardware.
Yes. So I'd caveat and say it's easier in a way at the growth stage because you don't have the same levels of risk, right? So remember, we invest when we're already seeing product market fit and revenue, so that the data that we have and the decisions that we're making are slightly different.
Yeah.
So
you don't have years and years of pure tech risk.
No, we don't. And we purposefully do not want to do that because that doesn't fit into our risk return perspective. So it's unfair in a way. It's an unfair comparison, but I would say, listen, this is true for anything. It's true for anything new. And that's the power of an organization. The best organizations reinvent themselves. They improve themselves. They bring the people that they need to take them forward into an ever-changing world. And they're also open to changing themselves, and they're open to failing. They're open to getting things wrong in order to learn. It's true for VC, it's true for a startup, it's true for an individual. And I think that if you have this growth mindset, this mindset that you will always learn, and that you need to surround yourself with the people who can kind of help you move forward, and you need to be open to being wrong and to not getting things right, that fixes a tremendous amount of these challenges that you're describing. But it's one of the hardest things. It's culture. It's the culture of a VC firm. It's a culture of a pension plan. It's a culture of a startup. And culture is the biggest unique differentiator that any organization has. People can copy your product. They can copy your strategy. They cannot copy your culture. And I think that's one of the biggest assets.
Yeah, I think that's very true. And maybe speaking a bit to the point on culture, I'd love to ask you a bit about advice to founders operating in today's world, because it is a difficult one to navigate in. And maybe I'd love to ask, start this conversation on managing the founder investor partnership, because you're sitting at the very tail end, or at least the growth stage. So this is a bit of a different perspective from the very early stage. So I'd love to ask you about that. What do you see as the core ingredients, both for founders to keep in mind, but also for investors to keep in mind in making sure that it's a successful partnership?
I think the core is choose carefully. Be prepared. We're talking about being prepared. Do your homework. Don't pick a brand. And this is the advice to the entrepreneur. Don't pick a brand, pick an individual. There are individuals within great brand name firms that may just not be the right individuals for you, because they might not be as knowledgeable in your sector, or they might just not be a fit. This is not the person. You want to ultimately pick an investor who you feel comfortable telling when things have gone wrong. You don't want to be the good news type of girl or guy. I think you can easily tell whether that person's not going to be the person. It's harder to tell whether it is going to be, if that makes sense. So you can cross people out pretty quickly. And so doing references, not references from companies that the investor has given you, but references, companies that you've found, maybe companies that are no longer in the portfolio, so that, it might be more candid. But that's incredibly important. If your company is going to survive and is going to thrive, that person is likely going to be by your side for 10 plus years. So it's much more difficult to get rid of that relationship than people imagine it is. So that, doing your homework, picking for the right reasons is incredibly important. And then creating a diverse kind of, if you're thinking about the group of investors that you want around you, and therefore the board, it's creating a diverse board for yourself, not just diverse. What do I mean by diverse? I mean, people that have different life experiences. You may want to get an operator that's done built a company before that sits alongside your board. You may want to get somebody who has seen the scale way above where you are at, or somebody who is very good at in a certain geography. But do not pick the same people, copy paste around a table. It's not going to be helpful. And you also want to make sure you don't pick people who hate each other, because that doesn't help the dynamic. And I've seen that happen. So there's an art to creating the group of individuals that you want by you. One of the most important for me is pick someone who's seen companies go through really hard times and has been able to withstand that, help the company, as opposed to kind of panic or make rash decisions. Because even though you don't believe that when you're raising, because you believe you're going to walk through walls, nothing goes up and to the right. And you always will have moments where most great companies have had near-death experiences. And that's where the true colors of your investors come out.
This point on picking investors that don't hate each other. As an investor, how much impetus do you put on the existing cap table in terms of the individuals that are there? Because yes, it's the founder's job, but it's definitely also something I could imagine that you'd be looking at and saying, I don't think this is a fight we want to get into, because we know it's going to be a fight. Is that something? How do you manage that? How do you manage stakeholder relationships with the other VCs around the table?
I'm trying to think if there's been an investment where I've been like, oh my goodness, I really don't like them. I don't think that's ever happened. There's been instances, however, where we've looked at cap tables and we're like, there's too many early stage investors for this stage of the company, not enough growth stage investors. So would it make sense to bring another growth stage investor into the round and kind of keep, as opposed to having 3 early stage investors, have like 1 early stage and 2 later stage investors in this next phase of the company. So things like that. Oftentimes entrepreneurs will tell us whether, if they want help changing the board, which is a great, a new round is a great way to do that without pissing off your investors too much. You can blame it on the new investor on like a change of, where you're going next. And so we've helped them doing that as well. But it's all mechanics that you can work with.
Avid, one final question before we close. I know you have a tight deadline and I'm going to respect it. Or rather, now I kick it to you because it's up to you to now wrap up your answer. But it is a slightly big one, because I want to ask you, you're at the growth stage, so equity versus debt. Debt financing is something that definitely has some people very much firing red and saying, no, don't ever take it. And some of these voices are very big, like Paul Graham's from YC. So tell me, how do you think about the debt question at the growth stage?
I think debt should be used for purely it shouldn't be used for operational reasons. So if you are trying to plug a hole that you can't plug and you actually are bleeding money, you do not want to fill that hole with debt, because it becomes incredibly dangerous and it's not as flexible as equity is. You should actually either cut your costs or take an equity round at a down round rather than go and get a debt provider. That debt will sit with you and it's not going to solve your problem. It's just a short-term fix that often turns into a long-term burden. Debt should be used when you are completely in control of your revenue and your cost, that you have predictability and you know that you can pull and push certain levers and accurately predict kind of your cash flow and the future of your business. And so in those cases, absolutely. Or if you're nearing profitability and you're making an acquisition and that acquisition is profitable, go and raise debt. That makes sense, especially if you can get cheaper debt. But if it's because you're struggling to raise equity, or you think you're going to get a down round and you're not able to, you're unwilling to cut costs, debt is definitely not the answer.
Can you trust a debt provider to be a good steward, so to say, in terms of only providing you debt for the things that you should, or no? And that either no categorically, or no, only some will know how to play the venture game, and for that reason will respect the boundaries in terms of what you should use that for. And there are other players that will lend you the money because they see a good opportunity.
Listen, I think just like in VC, there's all sorts of debt providers and all sorts of people. I think that when you are negotiating, talking, presenting, courting a debt provider, you need to, as an entrepreneur, you need to present your plan and what you're expecting to do. And so if you know that you're exaggerating, the positive path of the business versus being realistic as to where you think the business is going to be, and you are giving them too optimistic of a scenario, and that's what they're feeding on, and you're not doing their homework properly.
You can do that to your equity investors and get away with it somewhat scot-free. It's not the same thing with debt providers. That comes by you.
Exactly.
Avid, thank you so much for joining for this episode. It was incredible to dive deep with you on the growth stage and everything about how you see the world, the themes you're investing in, and in the end here, close a bit on that. Always exciting. Thank you so much.
Thank you.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.